So first of all, they didn't pitch to it. If you find a great founder, you have to figure out a way to get into their company. They may or may not pitch to you. I think Marmar will be 2x of our first company.
Wow.
Just Marmar.
You're saying 170 million
approximately. It is a very risky asset. They don't fructify into large outcomes.
How do you evaluate any particular startup?
A lot of us have heard about this concept of power law, that when you take risk, 20% of the investments will do well, 80% won't. If all things go well, can this startup potentially be one of the 20%?
What kind of traits do you look in the founder?
The founder's ability to iterate and learn quickly.
Even for you and for the founders, how should they make a sense of that?
The math to value a company, unfortunately, at the stage where we enter, is not based on company performance. Because there is no performance.
If someone wants to enter into the VC, like for working, what are you looking for in them? Hello, welcome back to the Qurious Club. Today we are going to cover the world of venture capital, and for that we have Rahul Chowdhri from Stellaris Venture Partners. Thank you, Rahul, for coming on the show.
Thank you for inviting me.
So Rahul, what we do is we start with the journey of the guest first. So what's been your journey like? Where were you born, brought up, your studies, before you ended up where you are right now? I've
been very lucky, to have gone through a variety of experiences in life. So I was brought up in a city called Kota. It is now famous for all the education industry, but as I said, I was lucky to see that education industry grow in front of me. Passed out in '92, went to college to IIT Kanpur, then MBA from IIM Calcutta. Again, had the opportunity to work in BCG, where we were working with some of the large CXOs and helping them solve their problems. Moved to US with a software company called I2 as a software product manager, then a startup in East Coast called MarketRx. Came back to India in 2005. I had this wild dream of maybe starting something. Microsoft was a good landing pad, which is where my other two potential co-founders were.
Okay.
So I ended up joining Microsoft in their Hyderabad office. The startup never took off. I think the one big mistake we made was we never left our jobs.
Okay.
When I see founders today, that is one thing I judge for, whether they have taken that leap of faith in their own idea by leaving their jobs and run. Anyways, spent 2.5 years in Microsoft, and around that time I realized that as an individual, I like working in smaller setups. Microsoft is a great company, but maybe not my cup of tea. So I was looking out, and Helion was just getting started. In 2006 and 2007 is most of the current venture firms in the India got started. The first wave ever, as I would say.
Okay.
Several individual entrepreneurs who had done well in US were coming back, wanting to set a venture firm, and that is what Helion's journey was as well. Spent 9 years at Helion. I learned a lot about what to do and what not to do. And then 2016, 3 of us left. Stellaris got started. So last 17 years in venture. And most of my focus over the last 17 years and what excites me is building different consumer experiences for different segments of population in the country.
Correct.
I feel that consumers in India need to be served better, cheaper, need to be heard more. And I get real joy when startups are able to do it.
Correct.
So that's what I've been doing.
Got it. So Helion, all your partners, they were also in Helion, and then
yes, Alok, Ritesh, and myself, all three of us were at Helion, and one day we felt that we can build our own firm.
Correct. Okay, got it. So let's get the basics right, because everyone wants to understand how a venture capital works, like how that works. So help us understand first of all, what is venture capital? First that, and then how it got picked up in India.
Sure. So maybe I'll start with a very high level. In any country globally, if you need to become a dominant power in the world, you would see, you need to first of all innovate, make life better for your citizens, provide cheaper access to different services. There are different ways of doing it. In some countries, governments take that mandate. At least personally, I don't think that is the right role for the government. In some countries, very large conglomerates do it. But as you would see in China, in US, in Israel, a lot of the mantle has been taken up by startups. What I mean is that founders who have a desire that in 7-10 years, they'll build something which is very different for their customer segment. So time and risk capital is what they lack. They have the talent.
Correct.
And they don't have the patience. You can build a bootstrap business maybe in 5 decades. You will be Tatas and you can still do the same outcome. But if you want to do something large in 7 to 10 years, that is where the risk capital comes in. Most of the time, you will not see banks loaning such founders any money. They don't have their own money to spend millions of dollars building the base. And that is where the first institutional capital is what I would call venture comes in. It is a very risky asset because of the stage and the kind of ideas we end up backing most of the time. They don't fructify into large outcomes.
Yeah.
But that is the risk appetite which our investors are okay
to take.
For us to take, and hopefully few of them turn out to be large outcomes.
Yeah, of course, you take higher risk, the returns are also expected to be higher. Got it. And how is it different from PE and angels? Angels would be the first ones to get into company.
So angels are typically something which comes before institutional round.
Yeah.
Angels are typically individuals. Most of them would have been founders themselves, would have made money and want to give back to the industry, maybe some financial returns. But most of the time they are individuals, so their ability to invest is limited. Private equity, you can argue, is next stage to venture, where a lot of risk is taken out as far as business model is concerned. So the risk reward ratio is different.
Correct.
They take lower risk, and likely reward is also lower. That's where they can't take a risk of business going down. On every business we back, we are okay if company doesn't work.
Got it. So, and what is the investment thesis here at Stellaris? How do you see the companies, the industries, and the founders? How do you evaluate any particular startup?
So, the multiple questions. I would say, in some sense, we are also a financial institution, right?
Yeah.
It is not our capital; it is somebody else's capital.
Okay, explain how it works. Like, who gives you the capital, and then how it flows?
Yeah. So, as I was saying, we are one of the riskiest asset class in the industry. So our investors, they understand what we are doing. Now these investors could be of different kind. There are a lot of global institutions who have seen the reward of investing in this risky asset class.
Correct.
And they find that India is also an attractive opportunity. So there are these global institutions. This could be a capital like a Yale or a university endowment of Stanford. It could be pension funds in US or China or Israel. Then there are development financial institutions. So people like IFC, CDC, who also comes in with slightly different agenda, but they're also putting in money to create venture capital fund. There are family offices. Sometimes there are foundations whose job is that part of their asset goes in, part of their allocation goes into venture capital. So these are all set of different investors we will have. And our obligation is, while we are backing the risky asset class, our obligation is to provide them a return, which is commensurate to the risk they're taking by investing in a venture fund.
Yeah.
Right? So, end of the day, we are looking for return. Now, return, what is a good return? Different countries will have different risk profile. I would say, at a dollar level, if you can deliver, let's say 22% net IRR to your investors, maybe 3x net on their capital over a 7-8 time period, that's a great outcome.
Yeah.
Now that 3x net, it's very, very hard to do unless you have some very large outcome. And a lot of us have heard about this concept of power law, that when you take risk of the stage we are taking, 20% of the investments will do well, 80% won't.
Not.
So those 20% need to cover up for the losses, plus provide the 3x net to our investors. So when we are evaluating a startup, now back to a question, our primary objective is, if all things go well, can this startup potentially be one of the 20% outcome that we are looking at? So every startup need to be looked at with that lens.
Yeah.
Knowing fully well that we'll be wrong 80% of the time. So that is what we look for at a very, very macro level. Now within that, multiple things happen depending on the stage, depending on the individual investors. People have different styles of investing. There are 2-3 things that create large outcome. First of all is the team itself. Second is the opportunity. Third is the business model you take. Right? And the fourth is how much ownership as an investor you end up having at the time of exit. So these 3-4 combinations is what we try to judge. At the time of entry, there are a few things that we can judge. So we can judge, or we can try to build a view on the founder, view on the market. But as things pan out, over the 7-8 years, there is only so much we can control and gaze into the future.
Got it. And what are the traits you look in the founders when you evaluate? Because I think at the stage, and plus the stage you are entering, the main person is the founder. Opportunity and everything is there. Execution is someone who founders will do. Yeah. So what kind of traits do you look in the founders?
So that's a hard question. I think I would provide you a framework, but I don't know whether that is the right or the wrong framework.
Yeah.
Right. So I would say there are 5-6 things I would look for. First is the founders' ability to iterate and learn quickly. And the reason I say that is because any startup is a new idea.
Yeah.
There is hardly any precedence. Obviously, there are some patterns from the past.
Correct.
But every idea is new. Every startup is new. And you don't know what new stumbling blocks you'll encounter 2 years, 1 year down the line.
Yeah.
So the ability to evolve, learn, experiment, that is one big trait that we look for. The other is the ability to be a good leader. And why I say that is startups are nothing but vision for the future. So how do you create people around you, energize them, make them believe in your idea is very important.
Correct.
as you scale, it becomes even more important.
Yeah.
The third thing we look for is hustle and execution. As in, reason is that again, nothing is perfect when you're starting a company. So what you are looking for is, can you figure a way out and an answer to an imperfect scenario and still keep on building? And that is where, you can't just be thinking in the sky without executing it. Yeah. So that's the third thing we look for. Fourth one, which is important in some cases, is ability to sell. And it could be ability to sell to your next round of investor, ability to sell to your customers, ability to sell to your vendors and so on. And I would say the last piece is customer focus. And, sometimes it is underappreciated, but how anal are you about satisfying your customer?
Correct.
There are different ways to judge it, but those are 4-5 things that we look for. Now, clearly, ambition, drive, hunger, those are all kind of given.
Yeah.
So that is kind of given, but these are 4-5 things that we look for.
Correct. Got it. Yeah. And also, what are the stages you enter in? Like Stellaris, what is the typical stage?
So we are, as I said, we were the first institutional round. So generally in terms of stage, what people call seed and series A. Seed could be where you are 2 people with a business plan, or you have a product that you are just about to launch. Those are typically the seed ideas. Series are generally where you have some customers who are paying you. Sometimes you have repeats. Yeah. Sometimes you have signs of economics. But that is where you are. I think these are 2 different stages that we enter in.
Got it. Understood. And at this time, even I asked people, what questions should I ask you? So someone said that, how do you value a company? That stage. And even for you and for the founders, how should they make a sense of that?
So actually there is the math to value a company, unfortunately at the stage where we enter, is not based on company performance. Yeah. Because there is no performance. No. Right. So the way math works is, we estimate what is the right amount of investment needed in that particular company. We estimate how much ownership we should get when we are entering. Correct. And we kind of basically arrive at a valuation based on that, which is amount we are investing divided by how much ownership we want is the post money of any company. Got it. And that's how amounts are derived. We also look for that with our capital. Where would this company be, let's say 18, 24 months down the line? And if somebody was to value them at that time based on their performance, is there at least, let's say 2x jump in valuation from here on, which approximately again kind of meets our IRR threshold. Otherwise, technically, we might better enter at that stage because risk is lower. And even if you're not able to get your, let's say 20-25% IRR from where you're entering, or even higher, it is not worth taking the risk of seed stage.
Got it. And your typical IRR target, you have like 25% kind of?
In that range. Again, nobody, we don't, when we invest, we are not looking at it in that term. We are more looking as to how big can the outcome be and how much will it be for the fund. Yeah. So let's say if somebody is $2 billion as an outcome, if we own 10% at the exit, then it makes $200 million of the fund. The IRR is kind of subsumed in that because we assume that the average holding period is maybe 7, 8, 9 years. So yeah, that's where, like when we invest, we don't necessarily look at IRR, but more multiple size of.
Got it. And the funds, your funds, like how you would have started in 2016, 17. So how many funds have life journey has been?
So we are currently investing from a second fund. We started our first one in 2017. So 2016 is when we came out, about 9 months of fundraise. 2017 early is when we started investing from the first fund.
Got it.
2021 April is when we started investing from our second fund, which is what we are currently investing from.
So in that fund, like how much is that fund and what is the second fund?
Second is 225 million.
Okay. And typical then investment ticket sizes would be for you?
So in the current fund, we would invest anything from half to $6 million in the first check. When we enter, we keep almost equal amount for the follow-on in companies that are doing well. Yeah. So maybe 12 to 13 million or maybe $14 million over the life of the company is what we'll end up investing, including the follow-ons. And about 26, 27 companies is what we'll end at fund 2.
Got it. So I think one of the most, best investment of your fund would be Mama.
In the first fund.
In the first fund, okay. Talk us through that. When they first pitched you, what were you thinking about the company? Like what made you invest in the company? And of course, after that, everyone knows it's been a great investment.
So first of all, they didn't pitch to us. So it was other way around. The great founders, if you find a great founder, you have to figure out a way to get into their company. They may or may not pitch to you.
Yeah, correct.
That's so in case of Mammoth, that is what happened. So I'll tell you, as a fund, we are in some sense very top-down thesis driven. At Helion, I had invested in a few brands. As 2017-18 arrived, it was clear that a lot of third-party platforms like Amazon and Myntra and Flipkart were becoming quite large. Yeah. And what that meant is that there was an opportunity to build brands using online channels both as distribution and also in marketing channels. So both Facebook and Google were becoming large in India, and Amazon and Flipkart were becoming large in. Till then, the biggest challenge of building brands was that while you can build great products, getting to customer was hard, and making customer believe in a brand was very expensive, because you have to be on TV or print or radio and so on, and you have to be in a lot of general trade and modern trade channel. Correct. Without knowing whether this product will succeed or not. And online kind of took care of both these challenges. So that is where we felt that online brands still become interesting. Then within that, we looked at few categories, and beauty and personal care was very interesting. One is in terms of per capita consumption, it was clear that there's only one way this country will go in terms of per capita consumption in beauty and personal care products. It is also a high gross margin business. It's also high sticky retention. So that is what led us to feel that we should invest in beauty and personal care. And then it was a question of meeting. There were about 6-7 companies in that space at that time. So I ended up meeting Varun in Gurgaon. Was really blown over by what he was thinking, how he was thinking, and he was not looking to raise. He had not even touched his angel round that he had raised before us. I asked him, what will it take to come in? He had a certain proposition of, I will only raise if I'm getting this valuation. I felt, if they continue to grow at the same pace, another 3-4 months, one can easily say that it is a justified valuation. We asked him that if you are willing to spend 2 weeks with us, we'll get you an answer. And that is how that relationship started.
Okay. And how much you invested that time, and what was the multiple? Like, you still are the investors, or you've exited?
We still hold the public stock. We are not on the board anymore.
Got it.
The company is public now.
What would be the X multiple from your investment over there?
I think it is over 40-50x. Wow. It depends on the stock price you look at. But yeah, it clearly is one of the large, fund return driver, as you call it. As in our minds, anything that can return the whole fund. I think Mamaearth will be 2x of our first company.
Wow.
Just Mamaearth.
You're saying 170 million.
Yeah, approximate.
Okay. So now, you've been in this industry, in this market, you keep analyzing different markets, industries, how consumers are reacting to different startups. What do you think, if someone in their early 20s or whatever age they may be, if they want to build something in India, what are some things they should keep in mind? Of course, for everyone will have different industry in their mind, but what are the key things they should be aware of while building in India?
So, it's a hard question to answer, to be very frank. And I'll provide a generic answer. You can tell me if that is what you were looking for as a response. I can go more specific answer. See, when you're building a business, I think one of the biggest thing I would solve for is who's your customer and what are you which pain point are you solving for them? And then once you have a view on that, the next question is, how can you solve the pain point? How can you do it better than what they do today? And see, I would say most of the consumers are already in some sense satisfying their particular need in some way or the other. So if you think of entertainment, before, let's say, social media, right? People were watching movies, right? Or talking to each other. Or before Big Basket and Zepto, right? People were buying groceries. So it is not as if I was not consuming groceries before. Question is that, is there a pain point today in consuming grocery? And do I have a solution which is much, much better than what their current solution is? And then the last piece is, do I have the wherewithal to solve that problem? Even though I may have a solution, am I the right team, or do I believe I have the right team?
Correct.
To solve it? What will the capital be? And so on, right? So those are more macro level. Next question is trying to understand what can I do to start with. While you have a grand vision, which is 5 years out, there is no advantage of, or no point of having that vision if you don't know what next 6 months will be like for you. Which means, what will be your, let's say, MVP, as people call it. So,
what does that mean just for
what will be your minimum viable product that you would want to launch with? So when Flipkart started, they were not selling everything, they were only selling books. Because maybe Sachin and Benny thought that is where people start their online purchase, one of the easiest category to buy online. Nobody was providing that in India, and if you provide a great service, that is what the brand gets known for, right? And then you expand into other category. When Myntra started, they were doing customized fashion.
Okay, they started
that is what they would do, personalized fashion.
Okay.
And over time, they felt that why not sell fashion over? So different businesses start from different points of time, and then over time they figure out a larger market. So as a founder, you also need to do that. So those are a few things. Then also capital needed for that. Do I need complementary teams? Like somebody at a founder level, somebody at a founding team level? What are the critical functions to build that MVP? And then you go and look for the right partners to invest behind it. So these are the combinations I would say somebody should think of when they're starting a company.
Also, there's a premiumization happening, what does that mean, and how is it impacting like the Indian markets? Like, of course, the consumer industry which you are looking at, how is that impacting?
So, see, the word premiumization means that as people have more disposable income, let's say the basic needs are taken care of, people at that point of time want to improve what they're consuming.
Yeah.
Now that improvement would have different meaning depending on categories, stage of life, amount of disposable income you have. So if I'm using shampoo, maybe I want less chemical friction.
Correct.
Right? If I'm eating bread, maybe I want whole grain. So you are okay paying slightly more for the value you're getting. Sometimes it could be just aspirational quotient. Meaning you drive car X, you want to drive a different brand if you have disposable income because you feel, I want to get that experience, I want to feel that brand, I want to own that brand. So that is what premiumization means, where you're ready to spend more for that same need and get some value in exchange for paying more. What in Indian context, I would say, this concept called mass premium. So if I'm buying a Sunsilk or a Lux, can I get a better shampoo and a soap and a cream by paying, let's say, 20-25% more of what I pay to a mass brand? That is what premiumization means.
Correct.
And as people, as I said, have more disposable income, and to some extent, younger population who is not as worried about saving all the time, and that is because there is a lot more security they have in mind, right? Compared to, let's say, my generation or my prior generation. The tend to spend more on themselves will only go up.
Got it. Also, there is people make an analogy how from per capita income of $2,000 to $6,000, how China moved.
Exactly.
Similar path we are also taking. So again, those kind of industries will continue to grow.
Yeah.
Got it. Also, there's a new technology, of course, artificial intelligence, which I think even when I was in my previous work, I thought this would be way bigger and way faster than whatever technologies have been in past. How are you seeing that particular technology growing, and there'll be a lot of impact in a lot of industries?
Yeah.
How do you see that?
So we are quite excited if you think of two of the biggest tech innovations that we feel will change the world. One is the whole, I would say, the EV side, and the other bigger one is the more AI side. Now, what we think can happen, at least I can only share what I think can happen today, but I think the pace at which this technology is evolving, 2 years down the line or 1 year down the line, my answer is going to be very different. Right? But if I were to guess today, first of all, I think it will change the job market globally, especially jobs that are mundane and repetitive. There's a big risk that they may not have as many jobs around. A lot of that job can be done using technology. Third is just software programming will change. What that means is a lot more people can write code over a period of time, which actually might mean a lot more software programs will get written. And that is something that can change multiple industries. The cost of writing or the programmer will go down in some sense. Third is just anything which is digital. So be it education, be it content, be it gaming, be it social media, all of them will get disrupted. Which is great news. At least in some of these areas like education, I feel that while Edtech has been around, it is still not delivered on the promise of changing lives of end student. And AI allows us to deliver real education that, actually makes somebody more knowledgeable, more educated, without human intervention or with very little human intervention. So, multiple such areas that we are excited about as we look forward.
Yeah. Even when I was reading the book of Elon Musk, I think the whole journey of him is covered in that. I think he was raising alarms in 2015 that AI would be way dangerous than anyone can think of. That's the time I think then OpenAI started, at that time they started. And whenever I look his previous interviews, whatever he said is going right now. So that's how even I look at his interviews continuously, what he's saying, what he's doing, because he's operating at a different scale, different industries, which is way harder than anyone can think of. So I think that gives a view also of how this would be changing. He also said that there'll be a time when there'll be no jobs. You will have to provide a fundamental income, something that sort of for people to survive. That may be or may not be.
Scary but possible.
Yeah, it's scary and possible. But yeah, got it. Also, now I want to understand what was happening in the 2021 and 2022 when there was a lot of capital in the market and every startup was getting funded. Every day we were hearing this getting funded. Every week there was a new unicorn minted. What was that situation that time? Everyone was crazy behind backing startups, and why there's no, we see that time, and right now, there's no much funding available for startups. Help us understand what were you doing that time and where are you right now?
The advantage of a lot of gray hair is that you were, you've gone through such situations in past. So I would say those mistakes we had made in past.
Yeah.
And at least, so while I'll be frank, I won't say that we were not tempted, but we felt, just like share market goes through bulls and bear time. When we started Stellaris, one thing we said is that we'll build a strategy for each fund, and unless something fundamentally changes, we'll just execute on that strategy. One of the key elements of the strategy is pace of investing. We had seen that in bull cycle in past, you suddenly become very excited and end up making a lot of investments. But in bear cycles, you suddenly become pessimistic and you make few investments. Now the irony is, every investment we make will only fructify 7 to 9 years from now. How in that year do you know that this is the best time to invest or this is the worst time to invest? Right? Now, easy to say, hard to execute.
Yeah.
But we felt that let's put ourselves, watch each other and make sure that none of us deviate from that strategy. So our idea was that we'll invest any fund over 3.5 years. And we'll try to maintain an equal pace of investing irrespective of the environment. And that is what helped us in 2021. When we started the fund, we said we'll make 8 to 9 investments a year. In 2021, we made 8 investments. In 2022, when people were not investing, we made 9 investments. So at least that is now as I said, in 2021, it's not as if we didn't get tempted. As in, when everybody around you is giving a term sheet in 3 days, and from 10, they're making 30 investments in a year, you start having self-doubts. But kudos to everybody in the team. I think we kept ourselves in check. And the reason is not that those investments were bad. I would say it is this humility to realize we are not the smartest people to know which are the right vintages to invest in any, startups. So the only way to get out of that mentality of timing the market is what people do in stock market. They do SIPs. So think of us in some sense saying we'll do SIPs. Not that we invest blindly, but we'll make almost equal number of investments over the fund time. Today, I would say the market is much more saner. I like this market. It is neither bull market nor bear market. If you're building a startup which is really solving customer problem, which has margin structure in place, I think there are a lot of investors willing to invest. At different stages. And it will only become better, I would say. Next 10 years, at least my prediction is in next 10 years, a lot more global capital will flow into India, especially to the venture and the private equity ecosystem.
Got it. Understood. So also that time we saw a lot of frauds also being reported in different startups. What makes that happen? Like these kind of situations has arrived. Earlier people were taking bank loans and doing that. So what was that scenario happening?
So see, first of all, I would say if you look at percentage of funded startup, it was a very, very small percentage. So I don't think it is like suddenly they get a large percentage of founders going through that journey. There are a few that happen. And I would put the blame on investors and founders both, as in I think investors were also asking founders to change very different metrics. Only top line and just growth at any cost. And valuations that were driven by top line growth basically incentivize founders to build only for growth. Now, whatever it takes to do that.
Right. Correct.
So it is like, you can't blame your child when they're 18 that why did you develop this or that habit. You should have taught that habit when they were 3 or 4 years old.
Correct.
So I think I don't think there's anybody else to blame. Like investors and to some extent founders could have also maintained the standards they really think others should follow in their companies. But again, coming back, they're very far in numbers as far as percentage of funded startups.
And that's glamorized more because for news,
anything that is sensational is a great news article.
Got it. And also, I just wanted to understand one sector which you were also mentioning, EV. Talk us through that. Where is that journey where India is right now? EV adoption. Of course, there's the pricing at which the EV comes is again still not making sense for a lot of people who want to buy. How will that evolve for India?
So hard for me to predict in future, but you are right. Currently, if you look at pure financial reasons, it is commercial EVs that make full sense. And the reason is the operating cost on a daily basis because of the number of kilometers and commercial EV drives is very higher. Is kind of justified. Like in a lot of commercial EVs, we think in 10 months, the premium you pay is kind of recovered just in the operating cost saving that you're doing by not spending on petrol and diesel. So that I would say makes sense for financially driven choices we make as customers. On the consumer side, I would say few other things that will happen. One is obviously the cost of, I do have strong belief that Indian OEMs will reverse engineer and figure out better cost EV models than what globally has been the case. So it is not as if whatever is the global EV pricing will happen in India as well. Having said that, I think customer will make choice on comfort of driving. I have an EV, and I don't think I will ever go back to an IC vehicle because of the comfort of drive itself. Right? As more charging infrastructure comes in, then the anxiety of range goes away. So those are other things that will come into play. And then some people are environmentally conscious and they may not want to, contribute to pollution. Right. So multiple other reasons will also drive consumer adoption over the time. So yeah, that's what I would say.
Over the time, of course, the prices will also reduce.
Exactly.
And make sense. Got it. Okay, now, as you said that a lot of your companies also don't do well. So what have been your learnings with that? About the market, about the industry, and also talk us about what happened in the Edtech. Like suddenly there was a wave and now again that wave has gone down.
So first of all, see, there are multiple reasons why companies don't end up being great outcome for us. I think the biggest and the most dominant reason is when we enter, there is no product market fit here. And for whatever reason, we don't reach a product market fit with our money. And founders understand it, we understand it, that if you're not able to get a product that customer like, pay for, and you can make enough money on, it is okay to say it didn't work out. So I would say maybe 70-80% of things that don't work out will fall into that category. In few cases, sometimes it is competition. Maybe we didn't invest or back a company that should have been well funded. So in that sense, competition raised more money. It's a winner take all market and they win against you. Sometimes I would also say it's a founder market fit issue. Great founders, but maybe not well suited for that particular market. So those are maybe two, three big pieces. On the Edtech, I would say again, it was a frenzy of 2021. A lot of money and part of that is zero interest rate in US came into India. COVID made people feel that everybody will move online. And a combination of these two meant that companies were spending money on acquisition more than what they were spending money on getting the right product out. So a lot of that got pulled back. Money dried because interest rates rose in US. Customer acquisition without right product meant that retention was poor. Right, and in that sense, I think we are back to drawing board in a lot of these companies. We are very bullish in education, especially anybody who's building using AI in education. I would love to talk to that function.
Definitely. Okay. So last question: if someone wants to enter into the VC, like for working, what are you looking for in them? And of course, it's a small space, but a lot of people want to work. What would you recommend to them?
So two different questions. I think what we look for and what I recommend to them, right? So what I look for, first of all, is passion and hustle and appreciation of startups. It is very, very hard if you've never worked in a smaller setup to appreciate what a startup goes through. So I think that is the first piece, that interest and that passion and that empathy for founders. Second is problem solving skills. And what I mean by that is, you always, whenever you meet a founder, it is always a new idea. How do you come to a conclusion on whether or not to back that founder? In some sense, you're learning on the job as you're doing it. The third thing we look for is some ability to attract great founders to work with you. You can call it sourcing, you can call it charisma, you can, like whatever you call it, but point is, will great founders want to work with you? The fourth thing that we specifically look for is ability to build views and thesis on industries, ability to extract, move away from details, and arrive at insight on whether or not this is the right area to invest in or not. What I would suggest to people, I would say first of all, to my first point, do work in a startup. Either start your own company, work in a startup, irrespective whether you enter in venture or not. I think I would recommend it. I always recommend it to my kids. I recommend it to everybody. I think it's a very, very different experience. There's nothing better than working in a startup. It is like maybe in Israel going to a military for 2 years, right? I would recommend people to do that, irrespective of whatever you're doing in life. And if you like it, then think about venture. Venture is a very long feedback loop cycle also. So be careful, because for 5, 7, 8 years, you don't realize whether you are doing good or bad, whether you're liking or not liking. And by the time you are good for nothing in some sense, right?
Correct.
So be careful of that. But yeah, those are few things I would recommend. If possible, be part of some angel investment syndicate of knowing what is investing small amount of money mean for you.
Yeah, even I recommend to a lot of my juniors, if they say, because for them to best time to work in a startup is college time. The studies over there is less, and you just go do internship, whether it's money or not money, but you learn a lot of things. Even I recommend to the founders I interview, hire from colleges. They'll be ready to work it. That's the best, I think, way out. Thank you so much. Thank you for coming on the show and helping us understand the world of venture capital, and also explaining how, if you want to end up in a VC, what to do. Thank you so much for that.
Thank you.
Bye. Thank you. Bye.